Okay, let's unpack this. We have in front of us a very specific and quite provocative analysis report. It's centered on the near future forecast for Roblox, ticker RBLX.
Right.
Now, if you've been watching the markets, you know RBLX has been volatile. But this report doesn't just call for a recovery. It predicts a potentially massive, sudden jump in revenue and explosion, as they title it. And they've earmarked it specifically for the first quarter of 2026.
That's right. And our mission today is really to dig into the evidence behind this extremely bullish prediction. Because the current reality is, well, it's tough. RBLX closed recently at 73.27. And critically, it's trading about 50% below its historical highs, which were up around the 150 mark.
A 50% drop, wow.
Exactly. And the analysis doesn't ignore that. It actually uses it as the starting point. It argues that this current price, $73, isn't evidence of a failed company. It's an opportunity that the broader market is failing to grasp.
That sets the perfect stage for our first segment then. The analysis calls this current environment a bear trap. So if the stock has dropped 50%, what exactly are the bears, the doubters pointing to that has caused this massive pullback?
Fundamentally, it all comes down to market friction. It's rooted in these short-term fears about profitability margins. I mean, the core bear argument is pretty simple. Roblox is spending too much money. Too much to acquire users, too much to maintain its platform, so its path to, consistent high profitability is questionable.
So they're just looking at the P&L statement and seeing red.
Exactly. The analysis argues that Wall Street is essentially looking backward. They're looking at recent losses and margin pressures and just assuming that financial model is static.
That's a crucial distinction, isn't it? The market is pricing the stock based on yesterday's problems, not tomorrow's solutions. And we see that backward-looking sentiment clearly in recent analyst moves, like Wells Fargo lowering its price target.
Precisely. And here's a nugget of knowledge you really need to retain. Even when institutions lower their price targets, they often still see huge upside. The report notes that even Wells Fargo's revised target, $107, still represents a massive 46% upside from where we are now at 73.
So even the bears are kind of bullish.
In a way, yes. It tells you that this hidden value is universally acknowledged, even if analysts are adjusting for those short-term margin concerns.
Okay, so if the big fear is about profitability, why is this analysis so confident in such an immediate and dramatic turnaround? It feels like it's challenging the foundational belief of the current market.
It is challenging it directly. The report suggests investors who are only focusing on those trailing margins are missing the entire point. And the point is structural change. Roblox has been building 3 foundational mechanisms. They're designed explicitly to address those profitability fears and turn the whole operation into a long-term, high-margin cash flow generating machine.
So the market is pricing in the fear.
But ignoring the fact that the company is about to turn on the faucet that solves that exact problem.
Okay, let's pivot hard to the future then, because this is where the money is, literally. This analysis isn't just generally bullish. It targets Q1 2026 specifically. It's projecting an incredible 37 to 39% revenue growth for that single quarter. That's way higher than the general analyst whispers, which suggest maybe 19 to 21% bookings growth for the whole year.
And that gap is critical. It relies on a technical understanding that's really important. Most analyst reports focus on bookings. That's the currency people purchase Robux, whether they spend it right away or not. This analysis focuses on revenue, which is the moment those Robux are actually spent on the platform and get recognized on the balance sheet.
So it's about when the money actually gets used.
Precisely. They are predicting a massive conversion of existing currency and new purchases in Q1 2026. And it's being driven by 3 distinct and powerful catalysts, all converging at the same time.
That makes sense. We're looking for realized wealth. Let's dive into those 3 catalysts, starting with the one that feels the most immediate and quantifiable. What's driving catalyst number 1?
Catalyst number 1 is the ad revenue ramp. For years, Roblox promised advertising revenue as a fundamental stream of diversification. A way to monetize users who don't necessarily spend on Robux. The faucet for that, the infrastructure for scaled, immersive advertising was finally turned on in late 2025.
And what does that faucet even look like in a virtual world? Are we talking about like annoying pop-ups?
Absolutely not, no. This is where the whole metaverse infrastructure thing comes into play. The ads are native, they're immersive. We're talking about virtual billboards within high-traffic experiences, ad portals that developers can place in their worlds, and custom virtual brand experiences. They've moved way beyond simple display ads.
So why is Q1 2026 the magic moment for this new stream? Why then?
The timing is everything. That late 2025 rollout was essentially a test phase, the initial build-out. Q1 2026 is expected to be the first full quarter where significant scaled ad spend truly begins hitting the bottom line. Think about how brand budgets work. They plan their spending quarterly. This means major brands will be allocating significant marketing funds to Roblox for the very first time, recognizing Q1 2026 as the quarter of full platform rollout.
So it's a major, net new, and I'm guessing high-margin revenue stream.
Very high margin, yes.
Okay, that addresses the profitability concern by adding a new revenue source.
Yeah.
That only works if the right people are seeing those ads. Which brings us to catalyst number 2, the aging up demographic shift. It's still often dismissed as just the kids' game, a digital playground. Why is that narrative so outdated?
Because the data proves it is. I mean, while the younger demographic is still critical, the analysis confirms that the 17 to 24 age segment is the fastest growing demographic on the platform, both in terms of active users and, maybe more importantly, time spent. The platform is morphing into a true digital third place, a place to connect socially, not just to play games.
So if they're successfully aging up the user base, how does that actually translate financially? How much more does a 20-year-old spend compared to a 10-year-old who has to ask their parents for money?
Oh, the difference is profound. This is where the rocket fuel analogy comes in. That older demographic inherently has substantially higher spending power. These are users with jobs, they have their own credit cards, they have the independence to spend on digital goods. The analysis indicates that the average revenue per user, or ARPU, for this older segment is significantly higher, often 2 to 3 times higher than the core preteen base.
2 to 3 times.
It's huge. So when you combine the fact that you now have this high-margin ad network and the fastest-growing user segment has credit cards and disposable income, you create a powerful flywheel. They mature into high-value consumers directly on the platform, driving up that key 37 to 39% revenue projection.
That's a strong 1-2 punch. New, high-margin revenue plus more mature, higher-spending users. But the initial concern was about cost control. Let's tackle the third catalyst, which goes right to the heart of the bear trap: operational leverage and margin expansion. How does Roblox fix the margin problem that drove the stock down in the first place?
This is all about efficiency. It's about controlling the cost of goods sold. See, the initial margin problem wasn't just acquiring users. It was the cost incurred in supporting the incredible amount of content creation that makes the platform valuable. And now the company is aggressively implementing AI tools to fundamentally reduce the cost of that content creation for developers.
Wait, explain that process. How does AI make it cheaper for developers, and why does that expand Roblox's margin?
It's a mechanism of leverage. So developers create the worlds that attract users and keep them spending, right? Previously, building complex, detailed worlds was expensive. It was time-consuming. Now, Roblox is giving developers AI tools, think procedural generation, automated asset creation, rapid texturing, which drastically cut the time and human resources needed to launch or update an experience.
So better tools mean more content, faster.
Exactly. And since the development costs for the platform, which include developer payouts and technical support, remain stable, but the volume and quality of content they generate goes up dramatically, operational efficiency skyrockets. They are spending less to facilitate the creation of more and better content. This allows the company's margins to expand rapidly, directly addressing those profitability fears that cause the pullback.
So if the market has been pricing in the assumption that operating the platform is perpetually expensive,
Roblox is essentially saying, we solved that problem using AI and leverage, and Q1 2026 is when the accounting proof hits the balance sheet. The convergence of those 3 points, new ads, richer users, and cheaper operation, is what gives the analysis confidence in that 37 to 39% revenue explosion forecast. It's a triple play.
okay, that's a powerful trio of drivers. Now let's ground this in current reality. If the market stays volatile, what kind of financial stability does the company have to ride out any short-term dips?
They have a remarkably strong foundation. The analysis highlights they are sitting on approximately $2.9 billion in cash. That is a substantial safety net. It gives them the flexibility to invest in growth, withstand economic shocks, and prove their business model without needing to raise capital right away.
And how should we, the listeners, interpret the overall company valuation right now, given that $73 price point? Is the stock just cheap, or is it fundamentally undervalued?
The analysis argues it's fundamentally undervalued, especially when you look at it against its big tech peers. The report assigns them an enterprise value, or EV, of about $52 billion. And EV is, market cap plus debt minus cash. It gives you the total value of the business.
And $52 billion is considered cheap.
The report explicitly calls it cheap, primarily because they frame Roblox as the company that effectively owns the metaverse infrastructure. They aren't just selling games, they own the foundational digital economy where the next generation socializes, learns, and spends. So placing a $52 billion tag on that is viewed as a steal.
And the historical valuation metrics support that contrarian view. The stock is trading at about 11.8 times trailing 12-month sales. Why is that number important right now?
That TTM price to sales ratio of 11.8 is crucial because the historical average for Roblox has been 20 times or higher. If the company hits these Q1 2026 growth projections, proving the shift to profitability is real, that PS multiplier will snap back toward its historical norms very, very quickly. So you have a situation where a massive acceleration in revenue is being layered onto a historically low valuation multiple. That's how you get rapid price appreciation.
So we've identified the problem, that backward-looking fear,
Mhm.
and the solution, those three converging catalysts. Let's summarize the core conclusion of this analysis report for the listener.
The analysis is clear and unambiguous. It rates RBLX a strong buy Y at the current $73 level. It views this current pullback as a temporary opportunity. Their short-term target is a return to $100 within the next 3 to 6 months.
$100. And that's driven by the market just waking up to these Q1 numbers.
Exactly. That price increase is specifically driven by the market recognizing and pricing in those strong Q1 numbers as they become available.
And for those playing the longer game, waiting for the full maturation of this new model.
The long-term consensus target identified in the report is $143. That reflects a return very close to the previous all-time highs once the new business structure, the full ad ramp and sustained profitability, is proven and fully absorbed by the market.
So, to put a bow on this report for you, the current market sentiment, focused entirely on those backward-looking profitability concerns, is being completely overshadowed by these three powerful catalysts. You have scaled ad revenue, the higher spending power of that aging demographic, and AI-driven margin expansion. All three are set to hit the accelerator at the same time and drive that projected 37 to 39% revenue jump in Q1 2026.
That's the whole story.
For me, the single most surprising and powerful takeaway from this entire deep dive is just how perfectly the ad revenue ramp aligns with the demographic shift. It's that dual impact of a new, full quarter of scaled ad revenue combined with the growing spending power of the 17 to 24 demographic that forms the most potent financial synergy.
And that synergy raises the most important question for you to consider, because the analysis urges you not to be scared by the current red days, but to look forward to the potential green years. The real question you are left with is this. If the company truly owns the essential digital infrastructure for the next generation of socialization, as the analysis claims, is its current $52 billion enterprise value just cheap, or is it an absolute steal? That valuation of digital ownership is what you need to be mulling over.